Hey guys, this is Rudy for Bester Investor, and here I am on May the 23rd. It is Sunday, which means this is the Sunday edition of stocks that you should not consider buying. What I wanted to do is share with you guys an example of why it is so difficult to calculate the intrinsic value of a stock, regardless of which methodology that it is that you might actually deploy or use in order to calculate the value of the stock. So what I've done here is I have elected to work with one of my long positions. In fact, this is one of my largest positions in my portfolio, TD Bank. TD, for those of you who don't know, is a Canadian bank, and TD stands for Toronto Dominion Bank. What I want to discuss today is the Gordon Growth methodology of calculating the intrinsic value, and I'm going to show you how far wrong you can be, or right, depending on which way you think the stock is headed, when you use a particular model. So the most common way for analysts to calculate the intrinsic value of a stock and to make projections is to use something called DCF, which is the discounted cash flow. Basically, when you use DCF, you are effectively taking the future earnings of the company and expressing it in today's dollars, and then dividing it by the amount of outstanding shares to try and arrive at a potential intrinsic value or share price. It is really, really difficult to do. So let's take a quick look at TD, and I'll give you some examples as to why this is so tough. TD is headquartered in Toronto in Canada. As I said, TD is Toronto Dominion Bank. It has 90,000 employees around the world. It has approximately 1.7 trillion Canadian dollars in assets under management. It has a full range, by the way. 1.7 trillion Canadian dollars is about 1.5 trillion US dollars. So there's a delta of about maybe 25 cents on the exchange between the US dollar and the Canadian dollar in favor of the US dollar. TD offers a full range of financial products and services to over 26 million customers, so this is not a small business at all. Its branches include three key business lines: Canadian retail banking, mostly, and then they have some investing and other businesses attached to that. They have US retail, including TD Bank. TD Bank in the United States actually has more branches than TD Bank in Canada, and the reason for that is just that the United States population is 10 times the size of the population of Canada. And then they also have an investment in Schwab. Very recently, they actually sold TD Ameritrade, which is one of the software accounts and applications that I use for my personal wealth management, to Schwab. So TD, by doing that, actually has an investment in Schwab. They also have wholesale banking, which is included in TD Securities, and you can find TD on the Toronto Stock Exchange or the New York Stock Exchange, trading under the symbol, quite simply, TD. So a quick snapshot at the company. I'm not going to go into any detail here. I only want to look at two different things. Firstly, the last closing price, which was on Friday afternoon, that would have been May the 21st, $73. And then you look at the annual dividend yield. Currently, TD Bank pays a dividend of $2.52 per share, which at the current stock price nets out at around 3.44%. Now, the 2.52, so the $2.52, is effectively sort of a fixed amount until they change the dividend, and therefore the actual annual dividend yield, as expressed as a percentage, goes up and down, because the higher the stock price goes, the lower the percentage goes, and the lower the stock price goes, the higher the percentage goes, because $2.52 is expressed as a percentage of the closing stock price. The Gordon Growth model, which is what I'm going to talk about briefly because I don't want to bore you to tears, is a model that is used to determine the intrinsic value of a stock based on a future series of dividends. And this is one of the fundamental flaws, if you'd like, or faults of the Gordon Growth model, because it specifically targets and focuses on dividends only. And because of that, you can only look at a dividend aristocrat. So if you think of high dividend paying stocks in the Dow, for instance, companies like 3M would be an example, maybe even IBM. I don't think they've ever really cut the dividend. They always just go up in small little increments. So those are dividend aristocrats, and you can only really use the Gordon Growth model to calculate an intrinsic value on a company that has paid dividends over very, very many quarters, and always slightly more than the previous quarter or the previous couple of quarters, or whatever the case might be. The model assumes constant growth, and it's therefore only used for companies with stable growth rates in their dividends per share, like I just said. Now, this seems very complicated, and I'm going to simplify it for you in just a minute, but P is simply the price. In other words, the stock price. We just looked at it as $73, right? Then you look at the current value of the dividend. We looked at that too. It's $1.52 or 3.44%. You look at the dividend growth rate, and for the example I'm going to use today, I'm going to say, let's assume they don't even grow the dividend. In other words, I'm just going to use the current dividend. Then you look at the compounded rate of return in terms of how the dividend has changed and the dividend growth rate over a period. So let's get into the weeds here and we see what that looks like. So R is the compounded rate of return, and you can see the dividend growth rate over 3 years, compounded annual growth rate, CAGR, is 7.67%. I can use any of these. I'm just going to use the 3-year dividend growth rate because it's the most recent period that I have available to me. Of course, if I use any of the other two, the number is going to change nominally because there's not a big difference between 7.67 and 7, but there certainly is a difference between 7 and 9, for example. So I'm looking at the dividend growth rate over 3 years. That's R. What is G? So the dividend per share growth for 1 fiscal year. So I'm only looking at the 1 year is 5.74. And you can see the 1-year dividend growth rate for the trailing 12 months is 6.76. So those are numbers I can work with because they're basically related to just 1 year. And again, you can see the dividend growth rate just below that as an example. So if we look at the Gordon growth intrinsic value, because now I'm going to do the calculation, remember P equals D, which is the dividend, and then R minus G. So P is the price. So how much should the price of TD Bank stock actually be? So it currently pays a dividend of $2.50. Then we look at R and G, and because it's expressed as a percentage, I can divide it by 100, and I end up with 0.767 minus 0.574, which at the bottom here gives you a total of 0.0193. So if I take the current stock price, $2.50, and we assume no dividend increase for the next quarter or 2 quarters or the next year or whatever the case might be, we just use this as a fixed amount and say TD is going to continue paying $2.50 per share as a dividend. We divide it by the constant growth. So you can see over here on the left, I put the calculation in there for you again. You divide it by 0.0193 and you end up with a stock price, which is a projected value or an intrinsic value of TD Bank stock at $129.53 per share. So it's currently at $73 per share. So if you want to spreadsheet something to death, you can now see sort of what analysts do all day long, every day. The only difference is, as I said at the beginning, they typically use the discounted cash flow model, which has multiple variables, not just 3. And because of that, you can end up with a different price every single time you run a different model. And that's one of the reasons why it is so incredibly difficult to calculate the actual value. So if we look at the analysts spreadsheeting this to death and say, what is your average consensus in terms of TD Bank's price? It's $72.15. And of course, right at the start of this presentation, I said it's trading at about $73 per share. So they're kind of there or thereabouts. In fact, because it's trading at $73.03, they say there's a small downside because their analyst average target is $72.15. How about their opinion? 3 of them say buy, 6 of them say hold it, and 1 of them say sell it. One of the reasons why TD Bank is in my portfolio is because, number 1, it's been in my portfolio for a long time. Number 2, it's a foundational stock for me. In other words, it's one of those keepers. I just keep it, collect the dividends, and if there's gains on the stock price, that's nice. And if there isn't gains on the stock price, it doesn't really matter. I'm just collecting the dividends. So it basically sits there for me almost as an anchor or a hedge, if you will, compared with some of the other volatile stocks I have, like Occidental Petroleum. But anyway, the analysts say that the price target on TD is $72, and if I use the Gordon growth model, it's $120-something, $129. So one of us is horribly wrong, and I'm going to go with, you know what, I don't mind, $73 is just fine. As long as I can keep collecting the dividend, I'm okay with that. So that's basically sort of where we're at. If you look at tip ranks, you'll see TD is currently a 9 as an outperform, and basically they're saying you should buy TD Bank. Now, I am not going to suggest that you do buy TD Bank. In fact, I started this segment by saying this is the Sunday edition of stocks that you should not buy. But if you are invested in financial stocks, whichever they may be, I'd be interested to hear your opinion and your thoughts. I know in terms of my own due diligence that my most beloved sectors, energy and finance or financials, are way down in terms of where they should be trading. And that's why I have large positions collectively across many different stocks in financials and energy, because that's where I believe most of my growth in my portfolio is going to come from. But that's just me. I'm more interested in you because you're the smart guy. So tell me in the comments what you think. Let's get the discussion going and see where we end up. Thanks for watching. Take care. Stay away from COVID. Bye-bye.